figures from the International Labour Organization.
Many thanks for staying with us. This is Business Incorporated on Channels Television. I am Bisi Adebayo. Coming up, Nigeria's headline inflation down to 16.05% in July, but food prices higher since 2009. Plus, 2 oil fields in Libya closed after an armed group takes over pipelines. And Lebanese PE fund joins Nigeria to hunt for diaspora Africans' investment. We begin today's show here in Nigeria, where headline inflation reduced further from 16.1% to 16.05% on a year-on-year basis in July. The report released today by the National Bureau of Statistics shows the headline index increased 1.21% on a month-on-month basis, 0.37% lower than the rate of 1.58% in June. Core inflation, which excludes the prices of volatile agriculture produce, eased by 0.3% in July to 12.2% points from 12.5% in the preceding month. The core sub-index inched 1% higher in the period, representing 0.32% fall from 1.32% in June. Meanwhile, the National Bureau of Statistics has updated its record of selected food prices for last month in Nigerian markets, showing the highest increase since 2009. In a research report released today, the average price of a dozen of medium-sized eggs increased 33.09% year-on-year, but decreased 3.14% on month-on-month basis to about 500 naira. A kilogram of tomatoes averages 400 naira from 375 naira in June, a 5.1% increase month-on-month. The NBS reports a kilogram of imported high-quality rice declines 1.6% to 410 naira in June from 415 naira in May. A tuber of yam is priced at about 300 naira. Now let's see how the stock markets are doing at intraday, starting from Africa, where the numbers are mixed at intraday. Here in Nigeria, the all-share index is still pointing southwards, with which is down 0.38%. The South African Bourse is also 0.12% lower. The Egyptian stock market is higher by 0.6%, also at intraday. The Kenyan Bourse also ended Friday's session 2.15% higher. And it's a good start to the week at the Gulf stock markets, as all the major indices are up at intraday. The Abu Dhabi index is 0.1% up, while the Dubai index is also up 0.29%. The Qatar index is 0.08% higher, and the Saudi Bourse is 0.46% up. And European stocks are under pressure as the euro hits its highest level against the dollar in more than 2 years, after energy shares suffered following a hurricane that knocked out refineries in Texas. Investors also have their eyes on Brexit talks, which resume today. Well, let's talk to DWTV Channels TV financial correspondent Janelle Dumalon, who's at the Frankfurt Stock Exchange, to tell us more about market activities today. It's good to have you on the program, Janelle. Aside crude oil and gasoline prices, how else are investors pricing in the weekend of disastrous Hurricane Harvey in the United States?
Disastrous is certainly the right word, and we're seeing numbers come out of Air Worldwide. That's a risk consultancy that says insured losses after Hurricane Harvey are now somewhere between $1.2 billion to $2.3 billion. And specifically here in Germany, that is being felt as well, this pain that is being felt by the reinsurance sector. The reinsurance sector, of course, provides insurance to other insurers. And because of the nature of the reinsurance sector, meaning that it snakes all across the globe, impact is being felt everywhere. So just to give you two examples, here in Germany we have Munich Re and Hanover Re. They've both seen their share price drop by more than a percentage point. So clearly it's hard to isolate the effects of this Hurricane Harvey just to the States. Now, you've already mentioned just how much of an impact that this is likely to have on the energy markets, but there is also trade to consider. There's also the shipping industry. As such, investors are bracing themselves for a full accounting of the damage. But we've already seen that the dollar has gotten weaker after Harvey compared to the euro, after the euro had already surged following the central bankers meeting in Jackson Hole.
Now, talking about Jackson Hole now, what comforts can the markets make from all the sound bites from the central bank chiefs of the United States, the ECB, and Japan?
You know, it's genuinely hard to tell because the reactions were so mixed. Now, I've already mentioned that the dollar hasn't made any kind of comeback after a lack of signaling from the Fed Chair Janet Yellen. Because she didn't say anything, traders seem more likely to think now that further rate hikes might be slower in coming. But the European reaction was actually a bit harder to parse than that. Now, Draghi notably refrained from talking the euro down. He didn't say anything to sort of rein in the surging euro. And investors are worried about the impact that will have on exports. On the other hand, they think that it is also possible that because of the lack of comment reigning in the euro could remain strong, and thus quantitative easing could be the end of quantitative easing could be slower than anticipated. On the other hand, because he didn't say anything, that could also mean Draghi's not at all worried about the euro and the continued health of the eurozone. So that means we will see tapering of QE as previously predicted. So the remarks gave no clear direction to the markets here, and European shares saw a broad sell-off as a result of that uncertainty. Now, it's also possible that Draghi is simply waiting for the next ECB policy meeting in September to give concrete comments as to the future of QE. Jackson Hole didn't provide the conclusiveness that investors were hoping for.
One more thing, Janelle. Brexit talks resumed today with the Labour Party saying it would like to see Britain remain in the EU customs area and the common markets post-2019 exit. Is this proposal music to the ears of the EU folks in Brussels, Paris and Berlin?
You know, if the UK stays in the single market and the customs union for a few years and continues to pay money to the bloc, say about 10 billion euros annually, which is what it pays now, that could be seen as a viable compromise. But even that is going to be hard to swing. So the UK has to first make an offer before the EU makes any promises regarding free trade, but that would be domestically difficult for the UK to do. Now, the EU, on the other hand, will want to see this offer first from the UK before it makes any promises itself. And there's already this gulf between what the EU expects the Brits to pay, somewhere between 60 to 100 billion euros as an exit bill, and that is of course much bigger than what the Brits themselves are prepared to cough up, somewhere in the neighborhood of 40 billion, it's thought, even though they have not made a concrete offer yet. So again, the broad strokes of an agreement are possible here, but the devil will be in the details.
Well, thanks, Jalon, for those updates, and we'll see you again tomorrow.